When the company decides they're going to pay their stockholders dividends, usually there's three different dates. There'll be the date that they declare the dividend and say, yes, we're going to pay dividends. And it's going to say then, we're going to pay dividends to everybody who owns stock on this specific date, whatever that date would be. So just to put in some numbers here, the company, the board says we're going to pay dividends. We decided at our meeting on July 1, we're going to pay dividends to whoever owns stock as of July 15th. And then we're actually going to write the checks because it takes a little bit of time to figure out everybody who's going to get in. And we're going to send out those checks August 5th, those dividend payments. So dividends are simply a way, so if you're an owner of a business, if you are just an owner of a small little business, then you would expect that any profits you get to reap in that. Same here. Dividends are what they're designed is to provide a profit distribution to all of the owners. And so with a corporation, there could be lots and lots of owners. So you all get to split a little bit of the profit. Now, companies can decide that they don't want to pay out all their profits. They want to reinvest into the company. And so that's where boards have to make the decision. Do we want to pay out dividends? Yes or no? And then if we do we want to pay out everything that we made and have nothing in reserve? Or do we want to pay out just a little bit or a lot? They're going to have to make that decision. Stock dividends, if a company is kind of low on cash, they can still give out dividends. It's just not cash. It's just giving your owners more stock. So, and that's good if the owners decide to sell. Then when they sell their stock, they're going to get money that way through the selling of the new stock that they have. Usually when there's a stock dividend, the assets of the company don't change. Your value in the company stays the same as well. It's just you have more shares, and the more shares you have, usually you can get more money out of it later on. So I just gave a little example here. We declare $1,000 stock dividend, and the common stock is $1 par, and it's worth $3 a piece. So what I would do is how I would journalize this. I could debit my dividend, or the book is going to have you just debit retained earnings, because if you remember dividends, they get closed at the end of the year. And so instead of taking that extra step and closing it out later, they're just going to say debit retained earnings, which is okay. I like to go ahead and debit the dividend account if it was me, because otherwise why even have it? So you debit either one of these, and you debit it for the total value that your owners are going to get. They're going to get $3 a share, and there's 1,000 shares. They're $1,000 stock, 1,000 share stock dividend, and the par is $1 par, so common stock at par is 1,000 shares at $1, so 1,000, and then whatever's left, additional paid-in capital, is how you get your credit there. So that one's, as you can see, there's no assets involved. It's just a rearranging of all of owner's equity accounts. You're taking money out of your retained earnings, out of your profits, and providing it as ownership to to your shareholders. One of the last things we're going to look at now is the difference between a stock dividend and a stock split. With a stock split, there is no journal entry. Nothing officially happens on your books. The only thing that happens is par is cut in half if it's a 2-for-1 stock split. And the value, so your par is cut in half, and the value of the stock is usually cut in half, but the number of shares that you own doubles. So this is my little example here. We originally have 100 $10 par stock, and there's a 2-for-1 stock split. So if we had 100 shares, we now have 200 shares. It's a 2-for-1. For every 1 share you have, you now have 2. So instead of 100, I have 200. But the value of those shares, par value, isn't 10 anymore, it's only 5. So when you combine these, if you said I had $110 par stock, that's $1,000 of ownership. But then you think after the stock split, I should have more, right? Yeah, the answer is no, you have the exact same. You have now 200 shares, but they're only worth $5 each. So that's still $1,000. And you think, well, why would the company ever do that? Well, as you can see, what it does is it lowers the price of the stock. It allows more investors to come in if they want to try to divvy up the ownership a little bit or bring in more demand. So now if the stock was kind of stuck at 10 and nobody really wanted to pay any more than that, they can bring it down to 5. Now people are wanting to pay 5. They're okay with that. So the stock will go up to 6 and 7. So now you have 2 shares that instead of one being worth 10, you have 2 that may be worth on the market $7 a piece. And so now you can, instead of selling your 1 for 10, you could sell 2 for 7 each, and now you got 14. So that's why stock splits can be good for the owners. And that's what I'm saying here. Studies show that a stock split, those shares that split outperform those that don't by keeping the price lower. And as you can see, here's a little example of some of what happens on a stock split. There's no journal entry. So notice your common stock, your APIC, and your retained earnings and your total all stay the same. Nothing changes except just the number of shares and the par value. That's it. That's the only thing that changes. All right, our last 2 little tiny things here. Earnings per share, that's something a lot of investors will want to look at to see how the company's doing and if they want to buy their stock. Earnings per share basically is best case scenario. It says if the company gave out all of their earnings, they usually don't. They don't give out all of it. They like to keep some to rebuild the company, keep some for a rainy day. But if they did give out everything, how much would I as a common stockholder get? That's what this earnings per share talks about. And the formula simply is, okay, whatever net income is, how much money did I make? And then remember, preferred stockholders get dividends first. So we have to take their money out. Once I take their money out, whatever's left, then I share it amongst everybody that has shares of common stock outstanding. Notice it's the outstanding. It's how much are still in the public hands. Not that I've bought back. I don't pay dividends to myself as the company. It's just whatever's in the company's hands. And finally, when a question and we look at them, that'll say, what's the book value per share? So, we talk about book value and we talk about the value of equipment on our books. This is kind of the same thing. Book value per share, we're just going to look at total stockholders' equity and then divide that by the number of common stock outstanding, just like this. So the only thing that's different here is our numerator to figure out what's the value, the book value of each common share.